Are you ready to finally always get your direction right when trading? This is a topic that stumps most beginner traders. In fact, it's probably the last piece of your puzzle as to why you're not profitable just yet. I've made millions from trading, and here are the withdrawals as proof. And trust me when I say, no matter how profitable your strategy is, no matter how good you are at technical analysis, no matter how many hours you spend reading the charts, you will still lose money if you trade with a wrong directional bias. So, in this video, I'm going to fix all your trading mistakes when it comes to picking the correct trading direction. To do that, you're going to need to understand something called market structure. Now, what is market structure? Simply put, market structure is figuring out whether the market is more favorable for longs or shorts on that particular day, week, month, or year. And it helps you figure out exactly when the overall direction changes with key chart patterns. This is extremely important in your trading because you want to be riding the currents of the big banks and not go against them. Now, I want you to imagine, every single time you enter a trade, you have full certainty that the billions of dollars of banks are going to push your positions into profits, regardless of how much drawdown you're in. Now that's the power of understanding directional bias. In this video, I will break down the essentials of accurately diagnosing market direction into 4 simple steps. Number 1, basic building blocks of directional bias. Number 2, how to identify directional changes, meaning you know exactly when to flip for a short or a long. Number 3, external versus internal market structure shifts. And number 4, lastly, a supply and demand strategy to help you to use these concepts taught today to make money instantly. By the end of this video, you'll learn every single thing that you need to learn in order to get your direction correct like clockwork. So you won't have to keep guessing whether the markets are going up or down. So let's get right into the video.
Phase 1, beginner market structure. Now, I'll be going through things like bearish versus bullish market structure, how to draw your overall market structure on a chart, and most importantly, showing you real-life chart examples of gold. Now, these are the absolute basics of market structure, and if you're already familiar with this, bear with me here. We'll work our way up through the more advanced concepts later on. But if you're a complete beginner, pay very close attention as this will be the key reference point for this entire video. Before we dive into these lines and arrows, the entire premise of market structure can be stripped down into one single thing: identifying our directional bias. Now, what does this mean? It simply means the overall direction on where the market is going. For example, is the market going to trade higher or is the market going to trade lower? In order to unlock profitability, the absolute essential thing that you need to look down is identifying your bias and where the market is likely trading towards. Everything else is just extra confluence to improve your trading accuracy. But the bottom line here is, if your direction is correct, you are correct. With that being said, this is exactly how we'll get to an accurate bias. You see, most of the time, you are either going to be bullish, which means that you're trading higher, or bearish, which means that you're trading lower. Our job as traders, when it comes to identifying overall market direction, is to mark out swing points to determine whether the market direction is bullish or bearish. Now, what are swing points? The nerdy definition is this: swing points are the external swings of price leg before price reverses or continues. Simply put, they are the outside highs and lows of price. Let's see how this looks like on the charts. Here, on the left, you can see that we have a bearish market structure or directional bias. Let's mark out our swing points to determine this. The first swing is going to be up here because it is an outsider high point in price. The second swing down here is because it's an outsider low point in price. The third swing up here, the fourth swing down here, and so on and so forth. You get the idea. What you're looking for is essentially the highest and lowest overall points price goes to before reversing. Personally, I take into account the wicks of the candles as well, but I understand that some traders here, they prefer the whole body candle. Both are acceptable forms of market structure analysis, but personally for me and the purpose of this video, I'm going to use the wicks. So you can see very clearly that those are the swing points that have caused price to either continue or reverse. So when you successfully marked out these swing points like you see on the charts right here, you have then established your trend. Now let's start from the top again. Here we have a swing high that creates a lower low, and this swing low then creates a lower high. It's a lot of complicated terms, so let's break it down. What is a lower low? A lower low is a pattern that is formed when the current lowest point in the chart is lower than the previous low point of the chart. As simple as that. Now, what is a lower high? Simply put, this high right over here. As price begins to reverse, this high becomes lower than the previous high, becoming a lower high. Therefore, this in itself is signaling a high chance of potential lower prices. So, with this pattern on the chart, lower highs and lower lows, this tells me that the market is trending downwards. But the question is, what can we expect from price? Now, after price creates a new lower low, this is called a break of structure, a trend continuation. After price breaks structure, we expect some sort of a pullback or retracement. This retracement is bullish at the moment as price corrects itself from dumping but eventually still creates a lower high. So before we can see price on the right side here, we already had the idea that price is likely to dump. And with the correct confirmations, which I will talk about later in this video, continue lower. That's the whole point of market structure, to give you an indication as to what will happen from a directional buyer's standpoint. Now, if this isn't clear to you yet, this is a bearish market trend. Now, let's take a look at the bullish structure right here. This here is our swing low with no other lows beside it, creating a lower low. Price then decides to push higher, creating a higher high over here before pulling back for a retracement and then pushing higher again. Now, this new higher low now forms after creating a break of structure, breaking past previous higher highs over here. And the cycle continues. This is the age that the market gives you, anticipating the next market move with a directional bias in mind. We now know what's coming, right? So it is our job to try to get involved in this pro-trend trade and possibly the counter-trend trade in the form of this retracement. Effectively, given the right confirmations, market structure allows you to accurately predict the next two characteristics of price. Most traders rush into a trade with technical analysis, but 80% of the time, they get stopped up because they simply couldn't figure out the direction of the market. Now you have the basic understanding of market structure. Now let's get right into the juicy bits. Phase 2. Now, let's talk about change of character, or chokchi for short. In layman terms, a change of character is simply a potential reversal of a trend. Price dumps lower and lower and lower, and then suddenly creates a change of character and pumps to the moon. Now let's take a look at this example right here. With a swing low, price then pulls back, and then we set our lower high and our lower low. Great. Now we have a downtrend because we have identified a bearish market structure. Now we expect another lower high and another lower low. But what happens if that fails? When this downtrend continuation fails, we will know because the most recent swing high here will get broken. This high should not be broken if you want to see further bearish price action. If it does, then there is a change of character. The moment this high is broken, you can potentially shift your bias from shorts to longs. Why do I say potentially? Because when we get a change of character, it doesn't hold true every single time. Sometimes you'll get a fake up in price, and price will still continue in its original direction. This is what we call a fake trend change. If you don't wait for the correct confirmations, which we'll talk about next, you'll tend to get caught up in this a lot of times. Most traders make the mistake of getting caught up in looking for a change of character just to have a complete 180-degree turn and go in the complete opposite direction. Now, this is where true trend change comes in. When we identify a change of character, all we need to do is apply the same principle that we talked about earlier. Let's say we expect price to turn from bearish to bullish instead of lower lows and lower highs. We now expect price to set in a higher low and then a higher high. In other words, we need to see a change of character and then a subsequent break of structure to the upside to confirm a true trend change. So let me repeat that. You need to see a change of character plus a BOS to confirm a true trend change. Again, this stuff is very, very basic stuff. So understanding this is extremely important. Phase 3, external versus internal market structure changes. Now, in reality, market structure isn't going to be as clean as the examples I've shown you guys earlier on. It's going to look something more like this. But that's the good part, because it means that once you master this section of the video, you essentially be in the top 5% of traders that truly understand what market structure in the real market mean. Not some weirdo that can only recite technical analysis from a book and copy and paste. The market usually looks something like this. And from here, you can probably see why this is confusing to beginners. So it is our job to come up with a framework that simplifies this whole process. As you can see, there are so many different swing points right here on the chart. And the main reason why traders get lost is simply because if you follow the swing points alone, chances are you'll be on the wrong side of the market, chasing every single move only to be stopped out. So, how do we simplify this? We use the understanding of external and internal market structure. Think about external market structure as your outsiders once again, like I mentioned earlier on. In other words, your most extreme swing points. Now let's go through this example right over here. We know that this is your swing low, and then this is your swing high. So, until price breaks out either higher or lower at either of these points, nothing too significant has happened. The price area from this swing low to this swing high is known as our external range. Okay, price movement within this external range is called internal ranges. I repeat one more time. The price area from this swing low to this swing high is known as the external range. Price movements within the external range is what we call internal ranges. In other words, your internal ranges make up the internal market structure. Now, let's get back into our example here. We now understand that significant market movements only matter at our external structural points. However, most new traders will get stuck trying to catch all these internal moves and end up getting stuck in this cycle of chasing the next trade based on inaccurate or insignificant market structure shifts. For example, here they will see, we are setting in lower lows. Surely the market will go lower, not realizing that neither of our external structural points have been broken just yet. So until these areas are broken, we don't pay too much attention to the internal structures. Let's continue with the next example. Great. Now that we have broken the external high, this is a significant break of structure. Let's mark it out with this new external high line right over here. With this new external high, our external low also shifts. Shift to where? The lowest point where price put back, right over here. Now that we have formed a new external range from this swing low to this swing high, in the very next leg, you see that we form a brand new lower high and lower low. Again, this is not a significant move because we did not break past the external range yet. Soon after, we break the structure towards the upside, setting a new external high. Our external high range now shifts upwards once again, from here to here. And then until the next high breaks, all we got to do is just follow this framework. Just rinse and repeat it until we stop creating and breaking past previous highs. So what happens when we start breaking our external lows? We have a significant move to the downside. Now, that is what we call a change of character. Okay? So now our external high remains the same, but our external low now becomes this low that broke the most recent high low. But remember from the previous section, it is not a true trend change until we see a new external low with a break of structure past the low that was created when the change of character was created. Eventually, we get that and the market shifts from bullish to bearish. This cycle repeats itself time and time again. So now it begs the question, how do we get involved in these moves? Wouldn't it happen too late? That's where this framework comes in. Phase 4. The framework of making money using market structure. The golden rule here is all external ranges are new internal ranges once they are broken. Now let me explain. Our goal here is to use internal structure to form a bias and trade internal structure until our external range is broken. I know that sounds confusing, so let's dive straight right into an example. This is a daily chart on silver. I've marked out our external range here. So there are two ways we can look to be participants in this market. We can either play the range, or we can wait for this external range to be broken and then get involved in the markets. Let's go through this step by step. Let's call this the first external high 1. As you can see, shortly after, external high 1 gets broken. So this is a valid break of structure to the upside. This forms a brand new external high. Let's call this external high 2. Price then pulls back to a support area where external high 1 used to be. This is an opportunity for us to get involved in the markets to target a new external high 2. An extremely simple entry model can be just replacing a buy limit at this new support area with stop loss at this low here that was created before creating the external high 1. If price decides to break past this low, there is a very high chance price could continue lower, creating lower highs and lower lows, invalidating the bullish trade idea. Take profit wise, you should be targeting your external high 2. The reason why we are not aiming for higher prices, as explained before, after taking out an external high in an uptrend, is because we are expecting a retracement, and therefore I would want to secure my profits before it retraces. So let's see how this trade plays out. And there we go. 0 drawdown and smash full take profit. Let's move on to another example here. This is a 15-minute chart on Euro US dollar. Alright, we have an external high right over here that has just been broken with an impulse move. Let's call this external high 1 again. Alright, so we set a brand new external high right over here, and let's call this external high number 2. The pullback is once again to the support area where external high 1 was initially at, near a bullish fair value gap, which is identified by the gap between the first candle over here and the third candle over here. Similar to the first example, we can set a buy limit here with stop loss below the bullish order block right over here. If price decides to break below the bullish order block, price is likely to continue lower, taking out the external low over here. Target wise, what we want to do is target the external high 2 right over here. Plain and simple, same old. Alright, so let's see how this trade plays out. After a while, we can see that price chopped around but eventually hit our full take profit yet again. While it may seem easy while I demonstrate these concepts in these videos, but that's because I've been using smart money concepts for the past 6 years. I've experienced all the trials and errors and the pain of significant losses, even reaching to the point where I almost gave up. Look, my goal here is to help you avoid the same struggles that I went through. Although these concepts might appear simple, they require a deep understanding of market structure. So let me share with you some pointers to guide you towards this level of knowledge. Tip number 1. Do not trade past external ranges. Only play within the external range. When price hits an external range, high or low, it can do one of two things. Sweep it or run it. If you choose to buy at an external low, or you sell at the external high without seeing any appropriate confirmations, it could be too late to recover that position. This is what I call catching a falling knife. Thinking that you can catch the absolute top or the absolute bottom in the markets as it keeps dumping or pumping. Sure, this can work in your favor sometimes, but the opportunities for these are few and far in between. So let me show you an example here. Okay, as you can see, price on gold is creating brand new highs, and I bet some of you got caught in this trap recently. Alright, after creating brand new highs, I know that some traders shorted at the all-time high, without any sort of confirmation to sell whatsoever, getting caught in the pump and losing a shitload of money. Alright, so don't be that person. Make sure to only play within the external range. Tip 2, time frame alignment. When you're looking at market structure, it is extremely vital that you do not make such a huge jump when navigating the different time frames. For example, if you use the 4-hour external structure, you do not want to be looking for the entries on the 1-minute time frame. This is an extremely huge jump, and you'll be prone to a lot more market manipulations and get caught up in lower time frame choppy price moves, essentially giving your hard-earned money away to the markets on a silver platter. Instead, I would align the time frames as follows. So listen up very carefully. If you're using monthly external structure, drop down to the 4-hour time frames to look for your entry. Weekly external structure, 1 hour. Daily external structure, 15 minutes. 4-hour external structure, 5 minutes minimum. No lower than that. Let me give you an example of when you make such a huge jump when navigating the different time frames. So let's say you use a 4-hour fair value gap and you jump right into a 1-minute time frame chart. You would think that these are some bullish confirmations that you can capitalize on, right? You see a break past this high, and therefore you're waiting for the retest to look to buy up, perhaps. You then set your buy here with stop loss below the swing low on the 1 minute, and you get stopped out again. You try it again, get stopped out yet again. And you keep on going through this cycle until eventually you catch the pump. The thing is, how many hits do you want to take before you catch the right move? All you needed to do was zoom out into the 5-minute time frame and you would see that you would have no real confirmations, just a simple consolidation. If you zoomed out, you would have saved yourself at least 3 losses worth of trades.
Last but not least, submit to time. These concepts have taken me years to understand and be consistent with it. Rewatch this video as much as you need to fully grasp the concepts and, most importantly, trying to mark up your own charts. Start with the examples I've given you here and then move on to marking different trading instruments and see how price plays out. From there, you will understand market structure through your own unique way, and that makes it very powerful. Who knows, maybe you'll find your trading edge through market structure itself. If you have gained any sort of value from watching this entire video, make sure to smash the thumbs up button right down below, and of course subscribe to get updated when we release our brand new video. Right, and make sure to click the first link that you see down below to get updated when we hop onto live streams every single day from Monday to Friday, in both during the London and the New York session for some forex live trading. And with that being said, I'll see you guys in the very next video.